Hello friends, the COVID-19 pandemic, which is a once in a 100-year phenomenon, has had major implications on the economy and markets. Hope that all of you and your families are safe and healthy in the current environment. Since it's an unprecedented event in our lifetime, the situation on the virus is still very fluid and dynamic, though there are some early hopes of some vaccines and drugs which are emerging. Very frankly, it's very difficult to attempt or even try to see how the economy will pan out over the next year or so. Global economy is estimated to be in the negative growth zone, while India is expected to having a growth of about 1 to 2% for FY21. The resolution to the virus will lead to a better recovery in FY22 is also the expectation. Governments and central banks across the world have given fiscal and monetary stimulus in large proportions to help sustain the economy. 75 central banks across the world have cut rates in 2020 and more is expected. Indian government has also announced a package for the bottom of the pyramid people and is expected to come up with another package for the small and medium enterprises which are hit the most in the current environment. RBI has made several announcements during the last 6 weeks, including rate cuts, long-term repos, refinance, increase in ways and means advances to states and so on. The idea is to provide adequate liquidity, facilitate bank credit and ease the financial stress in markets. The impact of government announcements will have an implication on the fiscal deficit which will have to be carefully watched. Revenues and earnings for equity markets will definitely take a haircut during FY21. FY22 expectations will be a function of how the virus issue is resolved and the economy fares post that. FIIs have been sellers in equity markets while retail investors continue to invest through SIPs. Volatility is here to stay though. On the debt side, there have been a flight to safety and we have seen some turmoil in credit markets while GSEC rates have come down over the year. Here again, volatility will continue. KLI, as you are aware, follows a philosophy of safety, liquidity and returns in our debt portfolio. You will be happy to note that over 99% of our portfolio is invested in sovereign, AAA, A1 plus credit, implying very high degree of safety. On the equity side, we follow a bottom-up approach to investing and we carefully evaluate the business, management and valuation of each company we invest in. Overall, it's a process-driven and a moderate risk approach. You will be happy to note that the 10-year alpha in our opportunities theme is 2.7% and 2.2% in frontline themes. We have returned 9% CAGR in our bond funds over this period. We have also consistently remained in the first two quartiles across time periods. You should be aware of the benefits of long-term investing. The probability of negative returns in equity are zero over a 10 and 15-year period over rolling periods of time, in spite of so many drawdowns we have seen in markets, including the recent one in March 2020. So the advice is pretty simple. Focus on your protection and long-term saving needs, and above all, stick to your asset allocation over all the phases in markets and focus on goal-based investing. Stay safe, stay healthy, stay protected and stay invested. Best of luck.